A US recession will also come to India's tech hub. India's tech industry is currently ruling out the US recession. However, do you think that the recession will actually affect India? Or do you think that Infosys's current growth forecast upgradation is actually a good sign? Hello, guys. My name is Apoorv Pandey, and I'm back with the next episode. And in this episode of podcast, we will be discussing a key point, that is, what are the effects of recession in US? What effects can it be on India? And do we, as Indians and as workers in IT industry, do we need to get really scared, or what steps can we take? So, guys, the Bangalore based firm Infosys, which reported its June quarterly earnings on Sunday, which was yesterday, is considered the industry's weather haven. If it's optimistic about orders, then there's no reason to believe that the deal pipeline isn't drying up. US and European firms, from banking, manufacturing, retail to healthcare, utilities, all are still entering offshoring contracts, particularly those that will help them automate and cut costs. So, guys, in these scenarios, do you think that a recession will actually affect? Because Infosys is showing steady growth in orders, and yesterday it said that we are expecting more growth in the orders. Evidence of heightened activity is also visible in last quarter's 12% year on year jump in Bangalore office rents, three times as steep as Shanghai, Singapore, or Sydney, according to the Knight Frank. In the world's code writing capital, information technology drives more than two-fifths of the office leasing space. If the tenants are paying more for space, they must be upbeat about the future, obviously. But if that optimism well found, is that optimism well found? Look closer at the financial results of the IT firms, and you will see signs of stagflation in plummeting profitabilities. Infosys managed to boost rupee earnings by just over 3% from a year earlier in the June quarter, even with nearly 24% revenue growth. So, growth of revenue was 24% and profit jump was just 3%. A 20% EBIT margin, earnings before interest and tax as a percentage of revenue, is a 3.6% drop year on year. In fact, it's even worse than the bellwether outsourcing firm was garnering immediately before the pandemic gave a big lift to the business. At Infosys, the traditional office in Bangalore, there is another rival, Wipro Limited. The EBIT margin of Wipro fell to its lowest since September 2018 quarter. Partly that was because it signed up 15,000 plus new net employees, including 10,000 plus fresh graduates in 3 months through the June 2030. Infosys bumped up its headcount by more than 20,000 during the same period, while Wipro signed up 10,000 more freshers and a total of 15,000 new employees. But then again, the competitor HCL Tech, which hit the brakes by slashing quarterly net hiring by almost four fifths to about just 2,000. It also saw lower than expected EBIT margin of 17%, which is a multi year low. The margin of TCS, which is India's biggest IT vendor, was better, a little better at 23.1%, but it was still just 2.7 percent points narrower than the June quarters. It was more than 2.4% narrower. So, guys, again, here as well, we saw some negative news. TCS management had also indicated that the 7 billion to 9 billion worth of quarterly deal wins could be at a sustainable rates that's flattish from a year on year growth basis, which is as per the analysis. Profitability might remain under pressure for the rest of this year, both because of a slowdown in the west and the way the industry is structured in India. Offshoring is profitable, but the people it employs won't stay on their jobs forever without on site posting at client locations and those dollar wages. Correct? With the pandemic getting over, travel and visa expenses are also adding up. But the Indian vendors would struggle to get paid more. Customers will cite a near 7% drop this year for Indian IT firms in the rupee as a reason not to bump up the dollar prices. We have seen the rupee wise earnings will be falling by nearly 7% due to the depreciation of rupee. The exchange rate advantage, however, will be insufficient to make up for the rising pressure of rupee cost. One more thing, salary increases can't be skipped on. TCS employs more than 6 lakh people, but its attrition rate is almost touching 20%, more than double from a year earlier. Employee retention appears to be even more challenging at Infosys, where attrition surged past 28% in the June quarter. Startups that target India's local e commerce or fintech markets compete for the same programmers as these software exporters. So they are getting more better people. While small private equity funded firms are turning out cautious about burning cash on payroll, an employer's market for the coding talent is perhaps a story for the next year. With India's domestic inflation rate at 7%, IT services firms have little scope for belt tightening on wage costs. Ultimately, all of them will resort to pyramiding to protect their margins. It basically means putting a lot of inexperienced code writers under an experienced project manager and hoping that the client will still come out happy. But that doesn't happen always. But since rookies' productivity has limits, the more complicated programming will have to be subcontracted to small vendors. The cost of doing that are rising as well. The best bet for India's IT exporters is to hope that the US economy, their most important market, will avoid a recession, and that customers who ramped up their digital businesses during COVID 19 will keep giving orders. Will they? Clients may continue to see value in cloud computing, analytics, artificial intelligence, and even augmented reality, but their willingness to spend will be constrained by their ability to spend because of earnings pressure from commodity and wage inflation, supply chain challenges, reduced consumer spending power, higher interest rates, and likely below trend growth in the Western development economies. The large consumer tech companies such as Alpha, Meta, even Apple are witnessing a drop in their premium valuations. The more industrial end writing code for Western corporate consumers won't get immune either. India's Nifty IT index, which tripled between the onset of COVID 19 in March 2020 and the end of last year, has already slipped around 27% so far in 2022. Investors aren't as sanguine about profits as software exporters used to, and many of the traders who had recently bought or who started investing after the COVID period have just IT stocks in profits, and whenever they are required to take out funds, they are mostly selling tech stocks and IT stocks. The average buying price of certain these companies are also higher, which means that it will face more technical resistance levels as well. From other writers, which I have seen in the other newspaper articles, we have seen that they have indicated that the big tech apples may have to fall further. For Infosys, the world is no longer flat, and if we talk about the COVID's boom, now that boom is almost getting over. This overall column shares opinions and new and articles and data points that have been collected from various news agencies, and they do not at any point of time guarantee that the data is actually correct. So guys, thank you so much for listening. We have to clearly, we cannot disregard the probability of recession hitting bad in Indian IT companies, and if IT companies goes down, if IT stock hits recession, if IT companies face a recession fear, we will see overall plunge in the economy. So our best bet is to hope that a recession does not come in US, and even if it comes, The RBI is well equipped, but are the IT people? That's the main question. Thank you guys so much for listening. Thank you so much for tuning in. Do check our Telegram channel and subscribe to our YouTube channel. Thank you guys. Have a safe evening. Bye bye.